More with Oppenheimer senior research analyst Colin Rusch. Colin, great to have you with us. I first want to focus on the residential solar sector, which had already been under vast pressure because of consumer confidence, because of financing costs, so many other reasons, and now this. And I'm just wondering what happens in this sector. It's been re-rated, obviously. Is it enough? What happens to these stocks?
Honestly, this bill is bad business and it's bad policy. I mean, the reality is that the IRA was net generative of tax revenue by 2031, really starting to turn positive in 2028, and to the tune of $175 billion, according to the American Center for Progress, and ballooning beyond $500 billion of net tax revenue generation for the federal government by the middle of the next decade. So what the residential market is looking for now is a fix around really the leasing elements of the 48E credits, which allow for financing of systems at the residential level. And the reality is for utilities and consumers alike is that it's much easier to deploy dispatchable systems, which would be solar plus energy storage, at homes rather than building incremental distribution lines and transmission lines, which are expensive. They take a very long time. And so we're hoping that we'll see a fix. I agree that we're unlikely to see something with the reconciliation process. But right now, we're going to have to see what the rules are and then start problem solving from there as an industry.
So there's just like a lot of unknowns. As I understand it, for First Solar, a lot of you analysts out there thought that First Solar would be among the solar stocks that would be less scathed than the rest of the group with these tax credits ending. But at the same time here, the question mark is whether or not they can still get the stacked credits in manufacturing. When will we have some resolution?
It was a big surprise to see what we saw come out of the Senate last night, because we are seeing a material step down on an annual basis for the 45X credits, which are the manufacturing credits. And so for an administration that has touted reshoring and looking for manufacturing, where there's been some very significant investments, a lot of job creation for the solar industry, to the tune of 275,000 jobs in this industry, with a healthy portion of that being manufacturing jobs, to walk away from manufacturing, for this industry, just doesn't quite make sense. And I think that was a big surprise today. So First Solar obviously has some work to do around figuring out what they're going to continue to invest in this country. But there's going to be some jobs that aren't created. There's incremental investments for manufacturing in the U.S. that will not be made because of this bill. And we'll see electricity prices continue to go higher at an even higher rate.
So, Colin, not that it matters, but SolarEdge, I think, was almost a $400 stock 4 years ago. I think it closed at 16 today. The worst day on record. My question is there a winner in all of this? Is there the other side of that coin on the solar side?
Yeah, I mean, there's certainly names that do benefit. So we're looking at the utilities, the publicly held utilities that do win from this. You're going to see some of those folks like NextEra, and some of the other folks like NRG that have exposure on this space that are going to be net beneficiaries here. Certainly, we're seeing, some of the folks that on the construction side that can start charging higher prices here short term, because there's going to be a very big push to get construction done as soon as possible in the industry, are going to be able to raise prices to push these things forward. But, the real loser are consumers and really a lot of folks that have some very, I think, compelling jobs building the clean energy economy with this bill.